And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Two-year Treasury yields got right up against a 5% yield last week. That's the highest since 2007. Everyone baffled about what to do about the stock market is talking about buying short maturity Treasuries. Why try to figure out stocks when you can get almost 5% for 2 years risk-free? Let's talk to a recipient of all that interest. Joanna Gallegos is co-founder of BondBloxx, which runs a suite of ETFs that enable investors to invest in U.S. Treasuries. Also joining us, my old friend, Kim Arthur, founding partner with Main Capital. Joanna, we've seen big inflows into your short-term Treasury ETFs. A lot of people talking about bonds being back. But do you really think investors should seriously start to increase their allocation to Treasuries when a year ago everyone was saying the 60-40 stock bond portfolio is dead?
Yeah, well, that was a year ago before the Fed increased rates 425 basis points last year. So everything shifted in terms of yields year over year. And that number, that 5% number in the 2-year is incredible. You know, we're at historic highs for the 2-year and the 10-year spread. And it's an interesting time to make sure that you're doing everything you can to get your cash off the sidelines and get back invested for 2023.
Cash has no value at all. My mother called and asked me about 2 years. Now you know there's a yield top if there ever was one. Robert, I hear about these 2 years. She always bought CDs her whole life. The only thing you do know, cash is a complete loser. People ask me about what to do all the time. I say the only thing is 100%. Is it 5% inflation? Cash is a loser.
Yeah,
right?
And also, you know, the short end of the curve is really intuitive as well because we're looking down about another 100 basis points of rate increases. That's what the market's estimating in to the market until around July. So as interest rates are going up, you know, people are a little uncertain about what's going to happen to bond prices, you know, really far out. So if you get into at least the short side, you know, 6 months or 1 year or under 2 years, again, it's an intuitive trade. This is not 2022. This is not even 5 years ago. Yields are very fundamentally different.
Kim, as an investment advisor, where do you stand on this whole bond picture? What's the right place for bonds in a portfolio now? Let's at least just start with the short-term Treasuries that even my mother is talking about. Should we all just stop worrying and buy 2-year Treasuries? That's what my mother wants to do.
Yeah, thanks, Bob. Joanna, good to see you, too. That's a great question, Bob. I think, you know, we've got some fixed income allocations, and in general, they're yielding about 5%. They're about a 4-year duration. They've got a barbell approach where, just like you guys are talking about, we're definitely in the short end for 5%. And then we've got some barbelled with some longer dated treasuries, so no credit risk as a hedge against a recession. But I would say to your question, Bob, for the investors and your audience, that 1 or 2 year return, what do you do when you get to the end of that period? You have the reinvestment risk. So it's a portion of your allocation, but not the entire part, because as we know, over the long haul, equities will significantly outperform fixed income, and they'll give you that inflation hedge on top of it. So in general, if you're getting 4 to 5 points right now, that's kind of your return stream that you're going to see. But then, like you said, the duration side, you have the reinvestment risk. So we, you know, that's how we're looking at it.
Yeah, I'm very conscious of that myself. That's what I told my mother. Good for the next 2 years, but we don't know what will happen after that. I want to give you a chance to explain BondBloxx to us before and how it works. The key points are you own off-the-run Treasuries. Define that for us. You target duration. That's a little slippery concept. A lot of people have a hard time understanding duration.
Yeah.
And, of course, you insist it's a lower cost. So explain how BondBloxx ETFs work.
Yeah, so BondBloxx, the company, is the only issuer that's 100% focused on the fixed income investor and dedicated to launching new fixed income ETFs. So we don't have any, you know, ties or tethers to sort of the legacy products that are out there. So when we looked at the Treasury space, we observed 2 things. One is, first of all, they needed to have their price needed to be updated. You know, those Treasury products have been in market for almost 20 years now, and no one had taken the time to update them to a price that was more of an institutional level. So we're bringing institutional pricing back to all investors, and we've
when you say institutional, what does that mean? I mean, a lot of these bond funds charge sometimes 15 basis points. What are you charging?
Yeah, so we're charging 3 basis points on the shorter side of the portfolio of the product set. So pricing we thought was really in need of being updated. That's important. But also what we looked at is we looked at risk, and we wanted to update, we wanted to put it on the label for investors to figure out how much interest rate risk are they taking, especially in markets like these. And we think it was the right call because it gives someone an easy way to look at their interest rate risk that's embedded in their treasury portfolio, which is expressed as duration, expressed in years. So the name of our product represents exactly how much risk you're taking. 6 months, 1 year, 2 year, 3 year, 5 year. And we think that's more intuitive for people to put on this exposure in markets like this where we do have expected interest rate hikes coming.
I want you to explain off-the-run treasuries, because we had Alex on last week. He had on-the-run treasuries, which is you have a 2-year, and every month there's a new 2-year auction, and they roll into that new 2-year auction. So you're not holding the old one. That's on the run. You have off the run. Explain what that means. What are you getting?
So, so Kim actually made a good point. Like, if you buy a single bond, in the market, not an ETF, but a single bond, you are going to hold that bond to maturity, and you're going to get back par of that bond, and you would have gotten the coupons of that bond all through that maturity. But then when 1 year ends or 2 year ends, no matter, depending on how long that bond was bought for, you have to go back and buy another bond, and that bond is going to be at a new set of rates and at a new set of rates. What Treasury ETFs do, all Treasury ETFs do, is they buy bonds and they maintain that exposure to you. So they roll those treasuries forward for you. So if you always want to put on a 1-year treasury exposure or a 2-year treasury exposure, treasury ETFs are the easiest way to do that. The difference between an on-the-run portfolio and an off-the-run portfolio is, first of all, the BondBloxx products have both on-the-run and off-the-run bonds in their portfolio. It's both. On-the-run is just representative of when a bond is first issued. It's the first issuance purchase of those bonds. And then off the run is like, once a bond has been bought and sold a bunch of times, you can still buy it in the market, but it's just something that's past its first issue.
But in your 2-year target duration, XTWO, what are you owning exactly in this?
It's a portfolio of U.S. Treasury bonds, and it can have a variety of different maturities in that. But what you're getting is you're getting a specific yield and you're getting a specific duration. So the 2-year right now is yielding close to 5% in the XTWO. And you, over time, let's say in 2 years from now, you were to update that portfolio, BondBloxx does it for you. We roll it forward for you, so you can have a persistent yield over time. You don't have to have the inconvenience of trying to go buy a single 2-year bond. And we also are specific about the
And I want to explain duration to people, because it's a hard concept to get hold of. Duration is not the same as maturity. Duration is how sensitive you are to interest rates, right?
Yep. So as I mentioned before, the market right now is pricing in, depending on the probability, about another 100 basis points of interest rate hikes. So that's 1% more of interest rate hikes. And that goes somewhere up to July, so to get a time frame on it. So what you'd be concerned about, you just take our 1-year X1, XONE. The 1-year target duration ETF by BondBloxx will make sure that you have stable duration in that portfolio. So your risk is exactly 1 year. And what that means is that for every 100 basis points or 1% of interest rate increases that happen, the price of a bond will typically go down 1%. So it helps you understand the volatility of your price.
And how do you get that? How do you ensure that you're getting a 1-year duration? What do you have to do?
Yeah, so every month we rebalance the portfolio. We buy and sell bonds that create that exact duration. And so every month we rebalance it and make sure that we sell some bonds that aren't delivering the 1 year duration, and we buy some that are.
And the simple rule, this is the way I've always understood this, the dumb way, I think. If you have a bond that has a 2-year duration, for every 1% increase in interest rates, the price will go down 2%.
Correct.
Right. So it's a 5-year, for every 1% increase, 5-year duration, for every 1% increase in interest rates, it'll go down 5%.
Yeah, and that's what Kim was mentioning. If you go out on the longer side of duration, you're taking on more price risk. And some people want to do that right now because either they want to put a hedge in for if inflation does slow down and we get on top of what's going on. But the intuitive thing that's going on is people are investing on the shorter side of the curve because the volatility is very low comparatively.
So what's actionable in bonds right now? I mean, people ask me all the time, other than my mother wants to buy the 2-year treasuries, is there something else actionable? I know we've been talking about inflows into short maturity treasury ETFs. What about like longer dated treasuries, for example? What about high yield? Is there a place in the portfolio for that right now?
Yeah, there is definitely a place in your portfolio to take on more interest rate risk with longer dated treasuries, but not more credit risk. However, we think credit risk is really compelling right now, especially in what might feel unexpected in high yield bonds. So high yield corporate issuers are probably have gone through something very different than they have in past distressed markets. So if we think an economic downturn is coming up, you would think that somebody that is a high yield issuer may have trouble repaying their debt, and that's just not the case of the fundamentals in these high yield issuers. Their fundamentals are relatively strong versus pre-pandemic levels. They had a chance to refinance their debt during the pandemic,
at really low rates,
really low
rock
rates.
Bottom.
Their leverage ratios are typically are much stronger than they were in other downturns, and we think that investors have been mischaracterizing high yield even against equity risk right now. And with these yields, so on the very riskiest side, high yield is in triple C's is yielding over 13%. So comparatively, Kim was also mentioning probably an investment grade investment, which is targeting around 5.5% of yield.
Yeah.
High yield you're looking at in some cases on single B 8.75% and double B over 6%. So there's a difference in yield, and you're getting a lot in compensation for the risk right now.
Kim, what about that? How about high yield? I mean, Joanna has a point. If this is a downturn, it's a pretty strange downturn because normally credit risk emerges rather notably in a downturn. And a lot of people seem to believe that, and yet we don't actually see it. So talk to Joanna's point here, or are you on the same page with her on that or not?
Yeah, no, I am on the same page. And what I would add is one other thing. People's most recent experience was 2008 and 9, and that's why they have that recency bias that Joanna's talking about. 2008 and 9 was a train wreck. The corporations were broke, the banks were broke, and the consumer was broke. We had a credit crunch, and a credit crunch is a hard landing and really impacts high yield that has credit risk. Like she said, this is a much different setup. Particularly, it's been more of a rolling recession, so you haven't had everything hit at the same time. You had autos in 2021, housing at the beginning of 2022, goods inventories in the middle of 2022, commercial real estate here in the back end, technology. So it's been this rolling recession, which, like she said, it allows for that credit to be not as big of a risk. I would say that you get paid 3 points over treasuries for those high yield that she said, and it can go up to triple C's or you're getting more. That gives you your cushion, your protection that you're going to get. And there's other alternatives out there that can give you even more protection when that for that situation. But yeah, I would agree with her. We're looking also at emerging market debt. We think that there's a lot of interest in that, and the price, valuation, the yield that you get, and Bob, on top of it, it's really highly correlated to the dollar topping, which it looks like the dollar is in the process of topping. It's down almost 10% since last year in the fourth quarter.
Don't you have the same problem, though, with emerging market debt? When rates go up, emerging market debt has a problem, doesn't it? I mean, isn't that the typical?
Yeah, most of the emerging market indices are heavy on sovereign debt, and they're very sensitive to interest rate risk. And so another way we looked at the market last year was we launched an emerging market debt product that has lower duration, sort of a similar theme of giving more precision to that risk characteristic. And so the product XEMD that we have has actually reduced that duration by almost half. And we saw it really play out in the month of January, where the emerging market index, the traditional, really had, I think it was up, 4%. And it was, mainly related to the interest rate risk of the U.S. economy. So taking that out or dampening that is, we think, probably something prudent, again, facing more interest rate hikes.
Kim, you've got your own ETF suite. Up there you have the main buy right ETF. I want to give you a chance to talk about that. This invests in global equity combined with an option writing strategy. That was very popular last year. Describe what we own here.
Yeah, definitely, Bob. So in general, for the alternatives in call writing, this buy W, it excels in a flat to down tape. because you have the volatility that allows you to get paid during that period. So in a year like last year, when fixed income was down and equities were down, this buy W was up 1%. In a year like this year, it's up 5% already. But basically, if you go back to keeping it simple on high yield, what's the premium that you get paid over treasuries to give you downside protection? I mentioned 3 points. If you do the math and you annualize it out between now and the end of the year, you've got 6 points of protection from high yield. In a call writing strategy like this buy W, you actually have twice as much of protection over treasuries. You've got 6 points instead of 3, but you get an additional component, Bob. You get this in the money. We can write these calls that are in the money. So if you add the premium over treasuries plus the in the money, there's about 13 points of downside protection, or 2x what you get in high yield. So now, in up tapes, you don't want to have this type of a strategy because you're going to cap your upside. But down tapes, flat tapes, this is where these alternatives can, these call writing like the buy W can definitely excel.
Yeah, and everybody, these were very, very popular products last year. Joanna, why don't we talk about a favorite topic of mine, which is the modernization of the bond market. Equities became largely electronically traded 20 years ago. You see down here on the floor. When I got here on the floor in 1997, there were 4,000 people around us. They traded 80% of the NYSE on the floor. Today, there's, I don't know, 200 something. They trade 15 to 20% of the, so big change. But a lot of bonds still trade over the counter. It's amazing to me. How much progress are we making on making the bond market more electronic, and do we want to make it more electronic? What's standing in the way of becoming more electronic? Just sort of update us.
It's been a slower transition for the fixed income markets to go more electronic and to modernize. What's really interesting about the intersection of that time in equities, so there was an intersection between ETFs and that time in equities. As they started to digitize on the exchanges, ETFs kind of came into play, and they actually worked really well together. I don't know, I'm sure you remember, but ETFs, when they traded on the New York Stock Exchange, were in a room somewhere else where they were trading electronically. So they had some of the first, beginnings of what a full electronic market could be for the New York Stock Exchange at the very least. And then all of the interaction of ETFs over that time. Bond ETFs are 20 years old today, and they trade the same way that some of the technologies in fixed income that are just starting to grow really fast. They're just portfolio trading. Things where you're trading baskets of bonds in a customized way with clients. That's moving very fast. There's new trading platforms that are helping create more transparency to bond buyers, and it just sounds really familiar to the way ETFs had grown with the equity markets 20 years ago.
And does the sheer number, I always hear from the bond guys, well, there's too many CUSIPs, Bob. There's thousands and thousands and thousands, and it's hard to actually electronify that. Is that just a little bit of a canard, or is there any truth to that? What's impeding this from happening faster?
There are thousands of CUSIPs, but there's also a lot of technology that's been built in fixed income market making in the last 20 years where that is not as difficult as a problem to solve. You can easily imagine that. And then, I've got to put a shout out for the ETF markets themselves. They've been operating for 20 years. Fixed income ETF markets have weathered the GFC, they've weathered other different volatility events. And I think this last one in the pandemic really helped clients see what it's like to have something trade in a structured way, like in a portfolio,
even when the underlying products,
on a CUSIP by CUSIP basis, because you could really source liquidity when you needed it.
Even when the underlying products may be illiquid. The ETF
is trading, it's visible.
It's amazing how the market figures that out, isn't it? It's like it's magical almost.
And so I think that to some degree, I want to maybe plant the flag for ETFs, having all of these portfolios in existence and allowing the markets to figure it out over time, build the technology around them, and then for these products to have been tested through so many different events, the product needed to exist for people to interact with it. At BondBloxx, we see the next generation of that happening. We think it's going to accelerate really quickly from here. And what we observe is there aren't enough fixed income ETFs. If you could imagine that, there's only about 15, 70% of ETFs in the market are fixed income. And that's why we wanted to cut it all up into very, very granular pieces so people could exchange all that risk and we can see the next version of the modernization.
Thank you for coming. I really appreciate the update. This is just a hot topic, folks. We've done it 2 weeks in a row. And that does it for this week's ETF, though. ETF Edge. My thanks to Joanna and Kim. We've asked Kim to stick around and chat more broadly about the ETF business for the ETF Edge podcast. That's coming up. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.